Are you ready to supercharge your Tesla option trading strategy? In the next few minutes, we're going to break down a pre-earnings Iron Condor in Tesla that's going to enable you to maximize your profits. So whether you're a beginning trader or an experienced trader, stick around. We're going to break down exactly how to do it here coming up. Be sure and smash the like and subscribe buttons down below and download the free options workshop. It talks about the main benefits of trading options over buying stocks. An Iron Condor is a powerful option trading strategy that allows traders to profit when the stock price remains within a range. Here's how it works. It's a four-legged option strategy. It's ideal for stocks that trade sideways or within a range. It profits when the stock price remains between the two short strikes on the put and the call spread. So it does combine two spreads. There's a bear call spread and there's a bear put spread. Together, they create the range where you profit when it stays between that range. It's a limited risk and defined profit trade. So the max loss is the difference between the strike prices of either spread minus the net credit received. And the max profit is the net credit received when you open the position. As soon as you hit send and place the trade, that credit is in your account. The risk is capped because it's defined risk. So the Iron Condor strategy is a balance between risk and reward, and you can gain profits prior to earnings if you know that the stock price is going to have limited volatility or not move too much. Tesla presents a significant opportunity right around earnings. Here's why. Tesla has shown significant volatility traditionally around earnings, and this predictable volatility creates opportunities for Iron Condors. Tesla options typically experience a surge in IV headed up to earnings. This inflation in the prices makes selling options much more attractive. Post earnings, Tesla's IV tends to rapidly decrease, just like all stocks. This IV crush benefits Iron Condor strategies, which profit from declining volatility. So let's jump into a live trade on the option trading platform to show how we can set up the Iron Condor in Tesla pre-earnings. By the way, if you'd like to receive a copy of the free options strategies trading guide that outlines the different option trading strategies as well as their management, comment options guide down below and I'll send you the link. All right, guys, we're here on the Tasty Trade option trading platform. There's a link down below. Check out the platform. It's a great brokerage. I use it for option trading as well as Moomoo. There's benefits if you join through my link. What we're going to do is type in the ticker right here, Tesla, TSLA in the upper left, and we are on the trade page and we're on table mode. And we're going to go out. You can see right here earnings. We can see earnings is actually January 22nd. You can see here on the right. This is the earnings date, January 22nd. So we're going to go prior to earnings on January 17th, 17 days to expiration. Normally I go 30 to 45 days, but this is an earnings trade and it's prior to earnings. So I think the stock is not going to move too much. It's going to move maybe a lot after earnings, after they report and either beat or miss. If they miss, typically the stock's going to go down. If they beat, it may move up, but Tesla's been trading in such a range. It's actually down recently, but it traded in a range for a long time. And then with the election and the buddying up with the new administration, it's moved up, and they've got some things going on with batteries as well as humanoids and robotaxi, a lot of things going on. So long term, I'm definitely bullish Tesla, but it's had such a run up. Now it's right about in the middle of the RSI. So I think this is a great time to put on an Iron Condor. So the IVR is 74, so very high, which means we can collect good premiums and go wide on our Iron Condor option strategy. But again, we're doing this before earnings and missing all that volatility. We're collecting it because of the high premiums, but we're actually missing out on it, on the crush afterward, and this is gonna go to zero prior to the announcement of earnings. So great way to trade it. What we're gonna do, we've got puts on the right, calls on the left. I'm gonna go down to the 370, which is the 20 delta right here. So it's very wide, and I'm gonna click on the sell on the put side in order to sell the 370 put option. And then I'm going to go $10 wide, and I'm going to, so this is basically a stop loss right here at the 360. So it's $10 wide. We're collecting $1.85. Our max loss would be the difference between 10 minus $1.85. The market's open, so it's moving, you can see. And then that's the max loss right here, 564. But what's nice about the Iron Condor is you can only lose on one side. One side's going to be a complete winner, and if it stays in the middle, they could both be winners. And then on the upside, I'm going to scroll down and go higher, where the price is 410, but we're going to go again around that. We're going to go out to the 455, which is the 24 delta. So that's basically a 1 minus 24. It's a 76% chance of profitability on this side. We're going to sell the call, and then we're going to buy one $10 away, the 465. So this allows us to collect $3.45, which each option contract controls 100 shares of stock. So that's really $345 that we collect as soon as we hit this review and send. Now, you can see the buying power that we're using is only the difference between the $10 width, because we can only lose on one side, and the 345, which is 655, which is also the max loss. Our max profit is this 345 we collect up front when we hit that review and send. Now, if we go to curve mode, you can see the profit zone, which is huge. It's between the 370 and the 455. We keep the complete all of the 345. And then because we collect that 345, you can add that on the downside, and your break even is 370 minus the 340, and it's 455 plus 340. So it's 45840 is the break even on the upside. But I suspect we're going to stay within this range, 370 to 455. And if we go to here, that puts us all the way down 370, and then 455 right there. And here's where we're trading today at 411. Huge range that we can stay within just in the next 17 days, and earnings will not even have come out yet. So we hit review and send and place the trade. Trade management is always important in option trading. Now, we want to watch our position sizing. We never want to put on more than 5% on any one trade in our option trading portfolio. For example, if we're trading a portfolio of $100,000, we don't want to have any trades on that are more than $5,000 each. This helps protect capital if we have a move against us. And then we want to adjust the untested side. If there's a significant move up in price on Tesla, for instance, then we'll want to roll that put spread up to collect additional premium. And we'll want to have a predefined exit strategy. So, for instance, if we reach 50% profit right away, then we might want to consider closing that trade out and taking our profits. All right, guys, let me know in the comments below. Are you trading Tesla? Are you trading another stock that's doing well for you? Let me know the strategy you're using. Be sure and leave a comment, ask a question. I answer everyone. Remember to hit like and subscribe. Download the free options workshop. Thanks for watching. I'll see you in the next video.